Knowing what I know today, I would have done things a lot differently when I started investing. My investing journey started in April of 2023 with no knowledge or experience. I bought stocks, ETFs, and covered calls. In today's video, I'm going to share with you 3 ETFs that I would have bought to get myself started investing. As always, before we do that, we're going to look at my portfolio. We're going to see how it's performing and check out the metrics. We're going to buy some stocks, and we're going to look at the dividends that we got since the last video that I posted. My name is Darren, and this is the Crazy Canuck Investor, where I try to make investing a little bit easier for beginners because, let's face it, there's nothing that gets you ready for the first day you start investing. And I do it by sharing my journey with all the ups and downs along the way. Over to Netflix for a movie. The movie is called Leave a World Behind. And you've noticed I didn't say it's a recommendation. I'm going to leave that up to you guys. Leave it in the comments. If you happen to watch this movie or you have watched it, leave a comment. Tell me what you thought of this movie. It is an apocalyptic psychological thriller. Definitely a mouthful. You would think with words like that it would keep you on the edge of your seat. I'm going to dare say that my wife and I, it didn't do that for us, but maybe for you it will. The cast stars Julia Roberts, Ethan Hawke, and Kevin Bacon, so definitely some good actors. I'll leave it up to you to decide whether or not it was good or bad. Some good news in the world of finance. If you were watching the news today when I'm recording, which is the 5th of June, the Bank of Canada finally cut the key interest rate. This is the first time, I believe, in 4 years that they've done this, and I believe this is going to start impacting some of the returns that people are making in certain parts of the stock market. It could involve some bigger returns now for the REITs if you are invested in those. All right, so let's jump over to the portfolio and see how it's performing. The account is up to $142,294. And my account consists of 4 separate accounts: my cash account, my kids' RESP, my RRSP, and my TFSA. The TFSA is the star of this channel. I started this channel because I wanted to share my journey from day one to maxing this account out and all the bumps along the way. So if you're new to the channel or you're curious, go back, check the playlist, and see all the videos from start to finish. My cash account is up to $32,055. You're probably asking yourself, Darren, why is this cash account important? There's 3 things you should do before you start investing, and this is one of them. You need to have an emergency fund. It's best practice to have some money set aside for, loss of job or some other type of emergency. In my case, I keep that money in this Simple cash account, which earns me 5% interest. And last month, I earned $136.49 interest. I then take that interest and put it into my spousal account, so I offset the taxes because it is taxable. My kids' RESP is up to $64,473. Over the last month, it's up $1,717. Over the last 3 months, it's up $2,642. And over the last 6 months, it's up $6,393. And over the last year, it's up $8,880. That's a 15% return. And over all times, it's $8,880, again, 15%, pardon me. Net deposits are $55,000 into this account, and as I said, returns are about $8,000. Total returns are 15%. Looking down at the recent activity since the last video I posted, we made our regular contributions of $200, $100 for each kid into this account, and then that was then invested into EEMV, QCN, and ZEA. Now this account is a robo account. I do pay a fee. You can see the fee here. It's $22.40 for the month, and it will slowly go up as it's a percentage. We had a dividend from ZFL, which was then reinvested back into the portfolio. Over to my RRSP, it's up to $17,022. Over the last day, that account is up $122. Over the last week, this account is up $170 or 1%. And over the last month, this account is up $508 or 3%. Over the last 3 months, it's up $602 or 3%. And over the last year, this account is up $2,008 or 13%. And all-time returns are $1,885, which is 12%. Now we're going to check out the cash. There's 1 cent in there. There's no dividends that are currently sitting in there. I do have it set on drip, so any dividends that come back in will automatically get reinvested. Now looking at activity, I made a big move. I sold off my Manulife position equating to $584. I converted that money over to US funds in the account. Yes, I did get hit with a small 1.5%, and then I invested that money into AVDV and AVUV. Those are 2 small cap funds. We also had XEI pay out $11 and Fortis pay out $6, and both of those were then reinvested through drips back into the account. Jumping over into the tax-free savings account, it's at $28,500. Over the last day, it's up $208. Over the last week, this account is up $431 or 1%. Over the last month, this account is up $766 or 2%. And over the last 3 months, this account is up $844 or 3%. Over the last year, it's up $2,997, which is 11%. And all-time returns on this account are $2,955, again, 11%. We do have no money in it currently because we're going to transfer some money in. Stock lending is still being used. It hasn't changed since the last video. We've earned 24 cents total. The next payout will be June 14th. Okay, now we're going to look at the activity tracker to see what's happened since the last video. Only XEI paid out a small dividend of $10, and that was automatically reinvested through the drip back into XEI. All right, let's go ahead and deposit some money into this account. So we're going to transfer it from my cash account over into my tax-free savings account. That'll be $1,000. That's what I do every 2 weeks after I get paid. And then we're going to use passive to figure out what we're going to buy. So now that we've deposited that $1,000 into the account, passive showing that we're 88% accurate with our asset allocation, and we currently have $29,511 in the account. So the first thing that we're going to do is go through each one we're going to buy. The first thing is Plaza REIT. We're going to buy 11 shares. The next thing we're going to buy is QQC, which is the NASDAQ 100. We're going to buy 5 shares. We're going to buy 3 shares of RioCan or REI. We are going to buy 5 shares of VRE, which is an ETF that has REITs in it. We're going to buy 9 shares of XEC. And lastly, we're going to buy 3 shares of XEF. Pardon me, that's not the last one. The last one will be XIC. We're going to buy 7 shares of XIC. I'm going to spare you that and go ahead and buy them. Then we're going to jump back into passive and see what our asset allocation looks like. So here we are in passive, and we can scroll through and see the target, which is the blue one in this case for VFV, 40%, the actual 37%. So one stock that we bought would be REI. We're at 1.6% of the 2% asset allocation. So we're trucking right along. And next kick at the can, we'll be adding to more positions to keep up. And my guess is VFV will be one of those positions. All right, we're going to rewind the clock back to April of 2023 when I started investing. Like I said at the beginning of the video, if I was to start again, I would start off with these 3 ETFs. Now, assuming for me, which I did do, I started off in my tax-free savings account investing Canadian dollars. It's the most simplistic way. Your paycheck comes into your bank account, you set up your brokerage account, and then you transfer those Canadian funds into your brokerage account, and you can immediately start investing that. In my case, I use Wealth Simple. It's a very easy platform to use, and you can get started investing right away with as little as $1. It took me minutes to get my account all set up. The first ETF that I would start investing in is VFV, which is a Vanguard product. It invests in the S&P 500. That's the top 500 companies in the United States. And why do I think that that would be a good idea? because it is the best performing position that I have in my portfolio since I started investing. And you can see by this graph here that it is just a steady increase. In fact, in some cases, a very sharp increase. Now, there are some, downward trends from time to time, but that's how the stock market works. And why is that? Actually, let's go over a few things that are important to know about this particular ETF. So it's currently trading at $128.59. The MER, or management expense ratio, so that's what it costs you to buy it, is very low at 0.09%. It pays a dividend quarterly, so every quarter you're going to get some money back in your account. And if you're investing like I do, you take that dividend and then reinvest it right back into another part of your portfolio, or specifically via DRIP, right back into that particular ETF. So looking at a bit more information about this particular ETF and why I like it is, you can see here are the top 10 holdings of this ETF. The first one is Microsoft, then we have Apple, Nvidia, Amazon, Google, or better known as Alphabet, better known as Google, Meta Platforms, Berkshire Hathaway, and so on and so forth. These are companies that are very, very strong performers in the United States. And this is the reason that funds like this do really well. You can see that they're fairly heavily weighted in that sort of top 7 companies. And so therefore, I would buy this. The other reason is that this gives me exposure to North America, is how I look at it. All right, jumping over to the next one, it would be XIC. Now, what is XIC? XIC is a BlackRock product, so different than VFV, but essentially it's another exchange traded fund. And why do I like this one? Because this is the Canadian market. So it says here, why invest in XIC? Own the entire Canadian stock market. It's low cost and it's designed to bring a long-term core holding. So this currently trades for $35.16. And year to date, it has returned 6.17%. So that's a pretty decent return. And we can see here the performance charts showing that cumulatively this fund has returned 393% since its inception. And if we go to the next page, we can look at the holdings. Oh, pardon me, I should talk about the management expense ratio. This one also pays out quarterly, so every quarter you're going to get a dividend. And it's also eligible for DRIP, so you could either invest it back into another part of your portfolio or again, right back into this one. Scrolling down, management expense ratio on this is 0.06%, so again, very low. And looking at the top 10 holdings, we have Royal Bank, TD Bank, Canadian Natural Resources, Enbridge, Shopify, Canadian National Railway, Canadian Pacific Railway, Bank of Montreal, Brookfield Corp, and the Bank of Nova Scotia. So now this is just the top 10 holdings. That's not every holding in it. This particular fund has 223 holdings. Those are just the top 10. So if you're looking at exposure to the Canadian market, again, this is a great place to start. It's low cost. It's easy to invest your money broadly without having to pick certain stocks in the Canadian market. Take example, if you had invested in TD recently, say in the last 3 or 4 months, TD took a really big hit because they're facing some fairly big lawsuits and their stock plummeted down. You would be looking at a little bit less in your returns. But with an ETF, it's balanced out because your money is broadly invested. And the last one is going to be VRE, which is another Vanguard product. What is VRE? VRE is another ETF that has a basket of REITs. What are REITs? It's essentially real estate investing. And the nice thing about real estate, or at least for me, I like real estate because it's a steady performer. It's not like VFV where you get this really steep performance, but it's a nice steady, I would call maybe a hedge against downward trends in, say, the Canadian market if I was in XIC or in VFV. So this trades for $28.79. The MER is a little bit higher at 0.39%. It pays out monthly, so that might be important to you. The other ones paid out quarterly. If you're looking for monthly returns, then this would be a good ETF to invest in because you're going to see those dividends or distributions come back to you on a monthly basis. Now let's have a look at what's contained in this. All right, so here on the fact sheet, we can see that there are a number of different REITs: First Service Corp, Canadian Apartment Properties, RioCan, Collier International Group, Granite REIT, Tricon Residential, Choice Properties. So it's diversified across real estate. So looking at the sectors that we're in when it comes to real estate, you're looking at retail, you're looking at residential, commercial, industrial, and healthcare. So very broadly diversified, again, very easy. And with what I've learned about asset allocation, I would then set up an asset allocation appropriate. For me, I am keeping my REITs at that 5 to 10%, somewhere in that range. VFV is sitting at 30%. I have the Canadian stuff with XIC at 30%. And then that leaves some room for you to either keep some cash or bonds, or perhaps look at some individual stocks. But if I was starting all over again, these are the 3 ETFs that I would start with. If you made it this far in the video, thanks very much for watching. As always, give it a thumbs up. Leave a comment down below and tell me how your investing journey is going, or maybe provide me with a little bit of feedback or some suggestions on some videos that I might be able to do. I do respond to the comments. If you're not subscribed, make sure you hit that subscribe button as well. And if you know some new beginners that also might benefit from watching my videos, please share it with other people. If you're looking to support the channel, I have a link in the video description below. It's to buy me a coffee, and I'll put it up here on the screen. It helps me get through all of the labor-intensive editing and whatnot that I go through in order to make these videos. So thanks very much once again for watching this video, and we'll see you on the next one.